एक दो मिनट में स्टार्ट करते हैं प्रेजेंटेशन। Uh, good uh, good afternoon, everyone, and thanks for the joining this training program. We will be discussing today basic of commodity derivative. So we will start with. So this is our disclaimer that this presentation is only for the training purpose, and if you want to invest in the market, then you should seek professional advice. Now this is the flow of the presentation. We will start with importance of commodity derivative market. See, commodity derivative market basically commodity is normally consumer consumable things. So uh, so government has as of now approved 91 goods in which commodity derivative can be launched, but only 40 commodities are being as of now traded. So if you want to trade in commodity derivative, you first need to go through SEBI registered broker who is also member of the exchange, and then you have to deposit a margin, and then you can open a account with the member, and you can start trading in commodity derivative market. So now the thing is that what is the evolution of commodity derivative exchange? So if you go by the history, commodity is the first financial instrument in which derivative trading was started. In fact, if we go by the history, then CBOT was the first place or exchange where the forward or future transaction take place. So, and it was way back in 1848. So, it is a long commodity derivative is a long history, and even in India in 19th century only there were prominent commodity exchanges like Bombay Cotton Exchange, Hapur Chamber of Commerce for wheat and oil. So a lot of trading used to happen earlier also in commodity market, especially commodity derivative market. But in around 1950s, this 60s actually, the future trading was banned in India because there was a shortfall in of agri or essential item in India at that point of time, and the government decided to ban this trading. So again, when things opened up and we got self-sufficient in our food production, then In 2003, again the government approved to start trading in commodity derivative market. So this how the again the commodity trading started in India. So if we go by the prominent exchanges, then the CME, which was earlier part of CBOT. This is one of the prominent exchange today worldwide for commodity derivative trading. And then again, actually the CME and New York Board of Trade has all been merged into one entity, that is CME, and CBOT is also that part of that. So again, NYMEX is there, where mostly trading happens for the oil and gas and gold and silver. So then again in US, we have London Metal Exchange, which is a world prominent exchange for base metals like aluminum, zinc, and Dalian Commodity Exchange, that is in China. And China nowadays is the major consumer of agri commodity, all commodity in worldwide. So it is one of the prominent exchange. I have one query just to make this session interactive. The question is, in which year SEBI started regulating commodity derivative? So if you may answer in the chat box also. So these are some of the commodity exchanges uh, which are prominent exchange, like National Commodity Derivative Exchange, which is our exchange. So, so NCDX is basically prominent in uh, agri commodity trades. And then we have multi-commodity exchange, where major tradable commodities are internationally tradable commodities like metals, base metals, precious metals, or energy product like crude and copper. So these are mainly traded. And then we have ICX also, where multiple commodity trades on the platform. So these were exchanges which has earlier approval on the commodity trading side. Now government has also not government, SEBI has also approved um, uh, uh, equity exchanges to launch commodity as a commodity derivative as a product, their product. So in this the prominent two commodity exchange, two equity exchange, BSE and NSE, also launched their commodity derivative products. So in total these are the five exchanges where commodity trading happens. So some of the commodities which are traded on the stock exchange, these are some of the major agri commodity product which are traded on the exchange platform, like barley, castor seed, cotton, crude oil, menthol, rubber, and all those. So who are all the participants on the exchange platform? There are three type of mainly participant. First one is speculator, or we may say investor or trader. These are all part of this group. So these are those people who take a risk. You can also say him risk investor, because they are the people who are taking risk of the price movement in the commodity. So they are the risk taking people. Then there is arbitrager. Arbitrager are basically those people who just try to encash the difference in pricing of the two market, whether it is physical market and exchange market, or it is between exchange market to exchange market. So they are just opportunistic player who makes up the profit from the price difference, but they are one of the prominent player because they bring liquidity in the counter. And then the hedger, these are the people who who are basically the basically the physical players who want to averse their price risk through this platform. So this is one of the question for you. So you can answer your in the chat box. If somebody wants, he can also unmute and answer. Okay, we will go forward. So what is the composition of commodity derivative system? So these are the three main players or the institution where which are involved in commodity derivative exchange setup. So first one is the stock exchange. Stock exchange is the place, like NCDX is the place where the trading happens. Means some investor or the trader who takes position, they trade through the stock exchange. And the second one is their clearing corporation. As per SEBI guidelines, the stock exchange and clearing corporation has to be separate entity. So all the trades which happens on the stock exchange has to be settled through the clearing corporation. So every stock exchange has a clearing corporation which will settle all their trades. And then the repository is like demat account in commodity. Like if somebody has a physical commodity, then that commodity is converted into electronic form, and then it is being credited. So it is just like demat account in shares. Then there are additional stakeholders like warehouse service provider, which is unique for the commodity market system because commodity is a storable things. Then WDRA also comes into the picture because all the warehouses are regulated by India in through WDRA, and all warehouse which comes for the comes into the this commodity derivative platform has to be a WDRA accredited warehouse only. Then there is quality assessor who basically testify the quality of the commodity which is being traded on the exchange. And we have price pooling agency. Unlike equity market, commodity is not physical commodity or spot market is not tradable on the exchange platform. And to get the real price of the physical market, we have a price pooling agency which takes the mandi price through their polling mechanism. And we have farmer producer organization also, where farmer can come and deliver on our exchange platform their agriculture commodity or produce. So if now we will discuss how the commodity derivative as a product is designed. So suppose we say that chana is being traded on the commodity on the exchange platform. So what chana, what is the quality of that chana? What is the price center of that? What is the price means center for that price? And all those things. So basically we have some specific designed things which on which parameter this trade happens, like underlying, like in this case the chana will be the underlying. Then market. So this is basically a difference between the commodity derivative and equity derivative, because see, in equity the thing is that the spot market is also traded on the exchange platform, but that does not happen on the commodity market. So the underlying market is very fragmented. Like suppose we are taking for soybean, so there is not one physical market where soybean is being traded on into the hundreds of different mandis. So this is very fragmented market. Whereas equity is a organized market where spot also trade on the exchange platform. Then we have underlying supplying issue, which is very much true in current situation for soybean. Like we have a supply deficit in soybean, But this does not happen because commodity is a consumable item. It remains, it means there is a supply, there is a demand, and it get consumed. But in equity there is a constant supply. Like a promoter has uh, a promoter has to release a certain percentage of their holding into market for free float, and that is a SEBI mandate. So every company which is being listed, there has to be definite supply of shares in the market, and which remains constant. Only the hands change. Then market participants are traders, brokers, and FPOs in commodity market. But equity, basically the retail trader here means physical traders. So, but in equity market, basically that has been into retail and institutional investor only. Then price sensitivity. Commodities are very price sensitive because it is an actual consumable item. So this is how something price discovery happens on the exchange platform, and which actually boost the farmer's knowledge and his price bargain into the market, because they know what is the price of their product. Earlier there was a very means before this there was a very means opaque system where nobody knows what is happening in which market. And but due to commodity derivative, the price dissemination is very easier, and farmers are actually the beneficiary of this. So now, how price risk management happens on the exchange platform. So suppose a farmer is showing uh, uh, showing his crop, and he does not know what will be the price of his product 3 months down the line. So commodity derivative market, where he can signal the price and he can plan his swing in that way. Even he can come and lock his price or book his price through different finance derivative instrument like futures or options, which we may discuss later. So there are a lot of mechanisms which can help him in even knowing the price and locking the price. So there is some issue in the changing. Just a second. So there is one question from which stock exchange is having a major share in trading volumes in agriculture contract. So anybody who wants to answer can put the answer in the chat box, or unmute himself and give his answer. Okay. So we have got NCDX as the answer. Fine. So what are the key features of the product contract specific? Yes. So like we have designed a product, but what are the main things? How do we design a product? So in designing a product, like we say mustard oil. So how this what contract of mustard oil will be traded? So we first decide on the basis center, means which mandi the price will be traded. So in suppose in for mustard it's say Jaipur. So the price of Jaipur is traded on the exchange platform. Then there is a basis variety and tenderable variety. Means basis variety means key what are the what are the quality parameters which will be traded on the exchange platform. So there for every product different type of quality parameters. Then we have trading unit and delivery unit. So basically uh, 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 trading unit is the unit size which we trade future contracts, like for say chana, it's a 10 MT contract. So it's basically 10 MT is the trading unit, and delivery in unit is the minimum unit, which if you want to take delivery of commodity, then this will should be the minimum quantity. So in most of the cases, trading unit and delivery units are same, so not very much different, but obviously in some commodity there is a difference. So normally, if there is a difference, then most of the cases delivery unit will be higher than the trading unit if there is a difference. Then the tick size means how the price will move upside or downside. Like if tick size is 1 rupees and current price is trading at means the best buy is at 1000 and tick size is 1 rupees, means the other buyer can quote his bid at 1001 on 999. And additional delivery center, like we have said basis center, then there are other prominent center also which we include for the delivery. And timing of commencement of trading means on which date this future contract will start trading. Quality parameter we have discussed. Delivery specification means means delivery logic, means how this at the end of the expiry of the contract it will be converted into actual delivery contract, or it will be settled based on the market price of the spot market. But in most of the cases, it is compulsory delivery contract, means if you have a buy position or sell position at the expiry of the contract, you have to give or take delivery as per your future position. And maturity date, due date, or expiry date, which means this is the last day of the trade. So these are the trade parameters on a basis, or on which basis the trade happens. And then we have risk parameters, like how we manage the risk of overall trading means so that price manipulation does not happen. So limit on the open position means there is a limit on which a certain players can take maximum quantity of trade, and this limit applies to the to the trader as well as his broker. And then again it is been divided into near month limit, far month limit also. So then we have daily limit of price fluctuation, which we say also in general language circuit limit. Means beyond that limit the trade will halt. If again there is in mostly there are two circuits. First circuit, the trade halts for a certain period of time, and again trading starts, and say even if the price hits the second circuit, then trading stops for the day. Then we have margin system, different types of margin, like initial margin, extreme loss, and basically just to so that the counterparty risk does not happen. And we have FSP also, which we decide based on the mandi prices, which exchange decided basically on the based on the mandi prices for settlement of cash settled contracts. So these are basically in financial instrument, which we say future contract and option contract, and these are the two instruments basically in commodity which are traded on the exchange platform, which in detail we may discuss later. So the very important thing, what is the benefit of trade on the future market? So first benefit for the is hedger. They are able to they are able to transfer their risk of their business risk or the trade risk or the price risk, whichever we want to say it. But anybody who wants to transfer his price movement risk to other player, they can do so. And this also gives long-term price signals. This is very important for the farmer. It is also very important for the industry as a whole, because they can have some planning accordingly. Then it is a good investment option. A person can diversify his portfolio through commodity trading, and these are the things. If suppose a corporate managers can reduce his means cost of capital by taking the margin benefit system of the exchange. So there is a question, what is basis of derivative contracts? So anybody wants to answer can answer in the chat. So we have like we have discussed earlier that we can we means commodity can is actually deliverable commodity in compulsory delivery contract. So we will see how this deposit takes place in the exchange warehouse. So seller who has a short position and wants to give delivery on the exchange platform, he has to book first the warehouse space and bring that material onto the accredited warehouse of the exchange for that commodity. And there his commodity, first his quantity should match. Like if contract lot size is 10 MT and deviation is around for plus minus 5%, then he must uh, bring minimum 9.5 MT of goods or maximum 10.5 MT of goods. So first criteria will be quantity. Then his goods will be assessed on the exchange. If if that is a physical testing commodity, or you can say peripheral testing is possible for that commodity, then commodity is unloaded and uh, and the assessor approves the commodity on itself. But if there is some lab testing required, then commodity is unloaded if peripheral wise it's good, and then the samples are sent to the lab agency, which may be place other than the warehouse, and then the warehousing agency has to wait for their quality assessing. And once the quality assessing comes from the assessor, then if it is being approved, then its e-receipt is generated. If it is not approved, then the depositor has to withdraw the commodity from the warehouse. Once the receipt is generated, it will be credited into the depositor repository account. That is his RP account, which is equal to demat account of equity shares. And once his RP account is credited, he can deliver the goods as per the settlement calendar on the exchange, and he will deliver the goods on whenever he marks his tender in the tender period, and on T+2 his settlement will be done for his commodity and funds. So how warehousing is important for commodity derivative? Because all the compulsory delivery contract at the end of the expiry will convert into actual physical delivery of goods, and so warehouse service providers maintains stocking of goods, and quality and quantity is basically the responsibility of the warehouse or the warehouse service provider. So he ensures the quality and quantity for the buyer. Means the seller has given the goods, so buyer, if buyer if buyer has any dispute, first he will raise the issue with the WSP. So first liability rise with WSP for quantity and quality. So a warehouse must there are two criteria. The warehouse in which is accredited on the exchange platform, it must be a WDRA approved warehouse. And the second thing is that the warehousing service provider or the warehousing company is already impaneled with the clearing corporation. Then so so the clearing corporation. So clearing corporation are basically the agency or the institution which is responsible for all the trades which has been done on the exchange platform to uh, to clear their trades. Basically, that is the responsibility of the clearing corporation. So the entities involved here will be clearing corporation, clearing members. So clearing members are those members. So basically on exchange platform, there are members who can only trade, and there are members who can clear the trades also. So that is a different thing. We may discuss it later. So only the clearing members who have clearing right can can participate into the clearing corporation mechanism. So and we have banks, clearing banks, which are basically for the fund and the repository for the delivery of the commodity. And these are the basically involved in the clearing of all the trades on the exchange. So the basically when we have discussed what are the basic things about commodity derivative market, how the market trades, or how the market functions, and now we will discuss some guidelines for the investor which they should follow and which they should not follow to be for the safe investor. So safe. So first do's are trade only through the SEBI registered members. So do not trade in means first any person who is not affiliated with the SEBI or the member of the exchange, then if you are trading through them, then the trade is very risky, and basically that is a illegal act, and the person who is trading through them may also suffer financial loss, and so we should only trade through the registered member only. We should insist that they provide the risk disclosure document. We should fulfill the KYC criteria, have a UCC code generated on the exchange platform. Whenever we trade, we have to ask the broker to provide the contract note for the trade which have been executed, and also once the member provides the detail of the trade, anybody can verify the trade detail on the exchange website also. So what we should not do, we should not have our greed by making money through hot tips or something like that. These are practices which has been banned by the SEBI. So anybody, if somebody is saying assured return, something like that, then we should not fall prey into their false promises. Do not take unsigned contract notes, because then in that case we don't have any claim on the our trades. Do not overtrade means we have whatever our capacity, we should trade only according to that. We should not leverage on our trades too much. Whatever, see, derivative trades are basically already a leverage trade, so we should know what will be the financial gains or loss through our trade. We should not share our internet trading password, pay brokerage to our members in which is more than as per the defined exchange limit. Again, we should register our email ID and phone number with the stockbroker, and we should basically have periodic statement from the broker to match our funds, pay mark-to-mark obligation to the broker, or dabba trading, which means basically illegal trading, and we should clearly avoid, because those trades are not genuine trades, and whatever we are paying, we should as a fee to the broker, we should ask for the detail of that. And do not like we have discussed earlier, for the false prey, means we should not get into our if somebody is committing a false assured return, we should not take it seriously or ignore it. We should not we must know what are the risk involved in trading. We should not do not means M2M, we should pay on a timely basis, otherwise there is a penalty. If we have some delivery obligation, then we must deliver the commodity on the exchange, otherwise also for that there is a huge penalty. So these were some of the basic things which are important for commodity derivative trading. Anybody if has some query, he may ask or put the question in the chat box.
Sir, good afternoon, sir.
Yeah.
Yeah, I want to know how many farmers are trading in agriculture commodity segment, sir. Is there any provision to know that?
Sir, farmers, we in KYC, we do not have any certain criteria for farmers where we can count the farmers, but FPO, farmer producer organization, right? So
Yes.
the farmer producer organization as an entity where when they register themselves, we get to know. And as of now, it's more than 2000 FPO organization has means has registered on the exchange platform and they participate exchange platform.
Okay, sir. Thank you, sir.
ठीक है. If nobody has any question, then I will close this meeting. Thanks a lot. Thanks a lot, everybody, for joining the session.
Sir.